Hello, guys. Welcome back to our SBL series. And today, our discussion is a deep dive into more of risk, which we have been discussing since the last two lectures. So, we'll be doing a deep dive on risk management and assurance. This is one of those topics that separates, good managers from great leaders. Okay, there is a difference between, being a manager and a leader. In SBL, examiners are looking out not only for identification of risk, but also for how those risks are managed, who owns them, and what the board sees, and how assurance is provided over controls. The discussion, the PPT that I am taking ahead, it will cover, a lot of practical templates, the Tara matrix, the heat maps, and the assurance model. And we'll try to bring in as many different examples from Indian or global scenarios. What you will learn right now is how to turn a long risk list into an actionable risk register, how to prioritize using impact and probability and residual risk, how to choose Tara responses with cost benefit logic, and how to design assurance using the four lines of defense. I'll show you exact language to use in exam answers and board memos. And I'll also recommend a couple of points that you need to, keep in mind if you want to improve the quality of your answers. When you are writing your answers, when you are doing your rough work in the exam, make sure that you identify the time horizon and the materiality threshold when you discuss risk. Okay. Now, there's been quite a bit of evolution, so to say, because the approach now is not just risk identification and remedying the risk, but overall risk management. Okay. So, most people stop at identification. They create a list and they call it a day. But modern risk management is a continuous life cycle. In fact, you have professions which are solely built on risk management. So what earlier was a once in a year tick checklist activity has now evolved into a far deeper career in itself, in which it's identification of risk, assessment, planning, implementation of certain plans, monitoring, and reporting. So, while we talk about risk identification and risk management, the first step is to identify what the problem is, right? So this is a systematic activity, not random. You know, what you should understand is that there are different stakeholders in an organization, and not every risk has to be evaluated from a financial risk perspective, although most risks ultimately will have a financial impact for the entity. Okay, now think about a company like IL&FS, that which was a leasing finance company which faced or which suffered multiple defaults, and of course it had to be downgraded, and you know how the story unfolded after that. Now several NBFCs after the IL&FS fiasco have started adding counterparty risk identification workshops, where they spend a lot of time in mapping exposures to specific projects and related entities rather than relying on balance sheet summaries. Globally, large banks also run stress testing exercises that deliberately use extreme but plausible scenarios to identify tail risk. When we talk about global risk management, or basically when we talk about what kind of different exposures could you be subjected to, you will have to understand that risk management is rarely or a localized activity. Risk management impacts organizations as a whole, and we need to understand how does each element tie up in the entire chain of events. For example, I just spoke about NBFCs. You see, just looking at balance sheet of companies and calculating certain key ratios like current ratio and gearing and all of that might not help you to identify how deep does the risk run. So at this juncture, at this point in time, it's quite critical that you understand that the mapping of risks has to be a very detailed activity which takes into account quite a lot of other factors also. For example, now you need to map the exposure depending on the quality of the client, depending on his global and local reputation, depending on what other defaults has he committed in the past. You should keep an eye on the changes that are taking place in the world around you. How are those changes impacting these customers? So it's like a 360-degree perspective that you need to develop. Then you need to assess the risk, convert qualitative lists into quantifiable profiles. Impact, likelihood will play a very important role. And then, of course, timing detectability. Just saying that a risk is high, what does that mean? What does high mean? You will have to say that, okay, high, the risk is high when the loss is greater than 50 CR or greater than 5% revenue within 12 months. That level of definition is, that level of comfort and clarity you need when you are assessing the risk. Then the next step would be to plan for each priority risk, choose whether to transfer, avoid, reduce, or accept. We'll unpack this in much more detail later when we discuss the TARA framework. Then implement a change management activity. Controls must be documented. You should assign process and activity owners. Budgets should be approved, and then the right kind of training also should be delivered to all the people, all the individuals who are a part of that particular activity. If you're talking about credit risk control, then all the individuals who are usually involved in a credit risk situation, whose jobs are directly impacted or who do credit assessment for all your clients, these individuals should be considered for upgradation of knowledge, and they have to be trained so that they do a better job at risk identification and risk management. Management part comes later, but identification and understanding comes first. And then, of course, you need dashboards with leading indicators, not just lagging losses. For example, instead of reporting fraud losses last quarter, track number of failed KYC checks per 10,000 applications as a leading KPI. That will help you to nip the problem in the bud. Okay, so see, when you propose identification of risk in your exam, you should follow that up with ownership and monitoring. Examples, you should try to correlate the given situation after identification. How do you tackle that particular situation? Who owns that particular process? And what kind of monitoring is required? And that is what examiners will truly appreciate. Now, when I'm talking about risk assessment fundamentals, I'm talking about impact, probability, and profiling. Okay, so when we convert a list of possible risk scenarios into a risk profile, we ask three consistent questions. What is the impact? How likely is it? And when could it occur? Okay, when you're talking about impact, don't limit yourself just to money. Show the four lenses: financial, operational, reputational, and strategic. For instance, a data breach for an e-commerce company means direct remediation cost, which is a financial impact, downtime in order processing, which is an operational activity, negative social media attention, reputational damage, and potential long-term user defection. I mean, users moving away to other websites because they find that their data is not safe with you. Or negative social media attention is bringing down the entire hard work that you have put in. In India, we have this the MyGov user data leaks or past telecom data exposures are examples, to show the reputational ripple effects. When I talk of probability, what I mean is tie probability to a time frame. Okay, use ranges that make more sense for an industry. For a commodity trader, high probability might mean 40% within 12 months. For a nuclear plant, high probability is still very rare, but the impact is catastrophic. Just imagine a Chernobyl-like disaster, for example. Always justify your thresholds. High probability means the event is expected at least once in a 3-year period based on historical frequency. So when you're talking of probability, it should not just be the chance, but chance within a particular time frame. Okay. And then profiling. Combine impact and probability into a prioritized list. It should not be alphabetical. Use scoring 1 to 5 for both, multiply for a risk score, and maybe, then you should sort that accordingly. But you should be ready to override pure scores for strategic sensitivity. Maybe a particular client might not be high impact in terms of the revenue that you are generating from it, but maybe it is a strategic client, it is a government client, and in that case, any misfire in that situation might have far reaching impacts for you. So such kind of a client would be a high risk profile client basically. And you should understand that risks have to be evaluated from all angles: supply chain related, forex related, regulatory related, product safety related, liquidity related, multiple fronts. Okay. And how exactly do you do a risk? What are the risk assessment techniques that you would want to employ? When I talk about risk assessment techniques, I'm basically looking at benchmarking, probabilistic modeling, and non-probabilistic modeling. What is benchmarking? You compare specific events or processes using identified metrics across industry standards. Okay, what are identified metrics across industry standards? Say, for example, the risk of food poisoning at your restaurant. Identify what are the or how many instances of food poisoning have been detected at other restaurants who are in the same range, and that should be your, and of course don't take the extreme outliers, but understand what is the industry average, so that that out of 1,000 people who dine, maybe there are 3 cases of food poisoning. That's a 0.3% that is a 0.3% chance. And then you will have to take that as the base and ensure that if the probability of food poisoning or the number of food poisoning incidents is more than 4, for example, more than 3, for example, then naturally it is a cause of concern. Probabilistic modeling utilizes historical data and simulated outcomes, including value at risk, cash flow at risk, and earnings at risk model. These approaches assess expected outcomes versus extreme scenarios using quantitative analysis. Now, for those of you who have done AFM, I'm sure you do recollect that there is a concept called value at risk. Now, what is value at risk? Every project, that you discuss, you try to, of course, when you are evaluating whether to invest in a particular project or not, you calculate the NPV of the project. Okay. And that is one activity which involves multiple data points. Now assume that all of these data points are changing, all of these data points are subject to fluctuations and changes. You develop a financial model you know, which gives you multiple such NPV outcomes under all of these different and changed circumstances. And then you know that for example, the NPV, the mean NPV is 100 and there is a standard deviation of around 20. What does that mean? On a good day, it can go plus 20, and on a bad day, it can go minus 20. Now, and that covers, say, roughly around 67% of the total outcomes. Now, when you say that there is a probability, while 100 is my average return or average NPV, my on a bad day, it can fall down by 30 also. And if it falls down by 30, my NPV will become negative. And that basically tells you, and at what threshold point will I get a negative NPV, and at what threshold point this entire system might go bonkers, and I might end up being ridden. I might end up, being burdened with a project that has stopped generating positive NPV for me. So I have to be very careful. I have to assess value at risk before I say yes to a project. And non-probabilistic modeling employs sensitivity measures, like, sensitivity analysis in that you studied in AFM, which is basically NPV of that particular project divided by post-tax PV of post-tax cash flows under consideration. That will give you the sensitivity of that particular item. What does sensitivity mean? Sensitivity basically tells me how much of a change in a particular item can I tolerate before the project becomes unacceptable for me. Scenario analysis is basically applying different possible scenarios. How all of us are perennial overthinkers. We think of all the possible worst outcomes when the situation is quite simplistic. But that overthinking attitude of yours can come in very handy when you are doing scenario analysis, and that will help you to evaluate or understand the worst possible outcomes of a particular project. And then you can plan your next action points to tackle that. Then when it comes to expert judgment, naturally hiring an expert who basically knows all the pitfalls of a particular activity, so that he can highlight, for example, the fraud risk factors that might come to trouble your project in the future. And that is where the lack of expertise comes to the fore. So what I mean to say is, you need certain experts for certain areas. For example, uh, I'm not an actuary, so if I have to make a very pessimistic judgment of the leave encashment that I might have to pay, then as a chartered accountant, I'm of no use to you. You will have to bring in an actuary who might tell you the worst possible scenario that might occur when it comes to processing claims with respect to leave encashment. So basically, you will have to use all of these techniques for risk assessment. Okay, now having understood that, let's see what we understand by impact assessment. Okay, how deep does the impact run? How far along are you impacted by a particular event occurring? Okay, now when you call something high impact, you must be able to defend it numerically or strategically. Now, let me give you a practical example, that you can also use in your exams or in real life. High impact means losses exceeding a material threshold. I mean, losses greater than 100 crores or losses greater than 5% of group revenue, or events that can cause lasting structural damage like license loss, criminal investigation, or a cessation of operations. An environmental catastrophe at a steel plant that forces shutdown. This is high impact because it halts production, causes penalties, and damages your reputation. Medium impact could be losses that are manageable with contingency reserves, cause operational disruption, but are recoverable within 6 to 12 months, or cause local reputational damage limited to certain stakeholder groups. I mean, a regional warehouse fire could cause distribution delays, but it does not bring down the entire company. But your server getting damaged, or your server down unexpected server downtime will impact everyone. Like, in case of Zomato, if their server is down on say 25th of December, when the number of orders is going to shoot through the roof, and it is on that very day that the server conks off, naturally the customers will not be able to place their orders, and then of course they will move on to a competitor. See, no one has the patience to wait and see what is going to happen and how the event is going to unfold. Nobody has the time to do that. So the easiest thing they will do is they will switch to Swiggy, which is another food delivery app. So naturally that is a high impact item. Low impact items are small monetary losses, uh, like service blips that are quickly rectified, or internal policy breaches that can be corrected without external disclosure. Like a minor supplier delay can be covered by an alternative logistics provider. That is fine. See, we define high impact as anything that could exceed X cross or cause a permanent regulatory intervention. Medium is between X and Y, and low is below Y, for example. It's just organization to organization. You see, whenever you discuss risk and you discuss the impact of risk, it's critical that you mention A, the time horizon, and B, the materiality threshold before classifying the risk. Okay, now what are the probability assessment categories? What is high probability, medium probability, and low probability? Again, see, probability is the trickiest to justify. You must tie your average qualitative language to quantitative history in some way or the other. For example, high probability is historical frequency or predictive models indicate occurrence within the time horizon greater than 25 to 30% per year. For example, a microfinance lender in a monsoon prone region, default risk is in poor harvest years might be high. You know, when I talk of medium probability, it's between 5 to 25%, for example, possible under stress or specific conditions. For instance, a mid market exporter may face medium probability of foreign exchange volatility affecting margins in any given year. And low probability is events with a probability of less than 5%. Rare events such as major cyber intrusions in a firm with robust controls, possible but extremely unlikely. See, high probability has to be based on internal incident logs showing, those events occurring in the future. When I'm talking about medium probability, you should be able to justify why is that particular item in the medium probability category. Again, it will have to be justified using some sort of a number. When you are writing answers in the exam and you are doing probability categorization, make sure that you support it with quantitative data. Your answer cannot be based just on qualitative points. Okay. Then what we have is the risk mapping and visualization activity. Once we have done risk identification, risk mapping and visualization activity is very important. See, for that we'll be looking at various tools in our SBL preparation. What you have in front of you is a matrix. It's a 2 by 2 matrix, and it has likelihood or probability on the vertical axis and impact on the horizontal axis. Okay, so this particular matrix, which we also call as the likelihood consequence matrix, I could call it that, for example. If you see, the impact and the likelihood or the probability are stated here. See, heat maps, we'll see them separately, we'll understand those later. But here, when I talk of the likelihood and impact matrix. I put points across on the x and the y axis. Maybe I could use a scale of 1 to 5, and I could have different colors to justify that. And you will have to place risks, plot each risk by score. For example, for a manufacturer, forex exposure, high likelihood, high impact, red. But residual after hedging, that shows actionability. Or uh, explain movement, use before after arrows. After implementing monthly hedging and setting stop loss limits, forex has the forex exposure has reduced in that particular period of time. And this will also help you to prioritize your actions in detail. Now something like this can take the form of a heat map. Okay, now what is a heat map or a risk heat map? Let me show it to you. It's again a very critical tool, quite similar to, the kind of matrix that you have on your screen right now. Let me show you a risk heat map. See, when I say heat map, something that is high likelihood, high impact will naturally be shown on the will naturally be shown with a color that calls for attention. Whereas an activity which has low probability and very low impact might be shown with, say, something like a green color, because green, by default, the human mind perceives green as a color of safety, whereas red is often perceived as a color of threat. So naturally, if the probability and the impact both are, that impactful, then it will be shown with a deep red color. See something like this. What I mean is something like this. You see, this particular item for an exporter, foreign exchange risk in this case would come on the rightmost red block, which probably shows the deepest impact or the most, pervasive impact, and at the same time the highest probability. Whereas some risk which has a very low likelihood of occurring, zero point 0.1, and which has, a very low impact, can be shown with a green color, which primarily indicates safety. And this is what is used in order to construct the heat map. Okay, on in the left hand bottom quadrant, what you have is low impact, low likelihood. As you move towards the right hand top corner, you have high impact, high likelihood items. So all of them will come together. And once you plot it, okay, once you plot it, you will know which category does your risk lie in. Okay, if it's a high risk item, it will high risk, high probability, high impact item, it will go here. Low probability, low impact item will go here. These orangish arrows, orangish boxes, they could signify high risk, but risk that or the impact of which has been diluted because of implementing certain measures. And the amber or the yellow zone, would be the zone of mid probability and mid impact. Now, to understand risk relationships, okay, how do these items tie down with each other? See, risks rarely sit in isolation. A single incident can cascade across categories, operational to reputational to strategic. Use simple cause effect logic. A supplier default, that is, a supplier has not delivered the material on time, will have an impact on production. Production will stop. You will miss out on deliveries. There is customer churn that will happen, that will lead to revenue shortfall. Ultimately, that will lead to stock price decline. That's basically pressing the panic button at the first possible opportunity. And then you'll have to place probabilities on each of these links. See, understand there's a difference between correlation and causation. Okay. Two risks may be correlated not because one causes the other, but because they share a common driver. Example, risk commodity, rising commodity prices and inflation driven consumer demand decline. So, see, the drive correlation means they have a common factor which influences both of them. For example, think about to explain you what is the difference between correlation and causation. I often use this example. What is the relationship between number of deaths by drowning and sale of ice cream? What is the relationship between these two? See, sale of ice cream increases in the summer months, and deaths by drowning might also increase in summer months because people go for swimming in rivers and lakes. So these two, sale of ice creams and you know right sale of ice creams and deaths by drowning, are not connected with each other in the sense that one does not cause the other, but both of them are connected with one common point, or rising anxiety cases and more purchase of makeup, for example. Anxiety cases and makeup, one might wonder how are the two correlated. But if you think of anxiety right now, without trying to be little any situation where people actually have anxiety, when you expose yourself to too much of social media, you constantly get that FOMO, and that might push you to feel depressed or anxious all the time. And when you watch something on social media, you want to look like certain people who you observe, you will purchase more of makeup to try and look like them. So again, these 2 points are very closely correlated with each other. Now, uh, the compounding effect. See, many multiple small risks can combine to exceed a certain threshold. For example, a moderate currency depreciation plus a logistics strike can jointly create a high impact situation for an exporter. I mean, imagine a 10% currency depreciation and 20% shipping cost rise plus 2 week port strike leads to 15% profit erosion. So all of these together could have a far-reaching related impact on the business. So you'll have to understand how these connect with each other and what combined impact could they have when you are assessing answers, when you are assessing the situation in the exam. Now, to understand what are related and correlated risks. Related risk, one risk directly changes the magnitude or likelihood of another. For example, a poor vendor audit increases supply chain disruption risk. So there is a cause, one is impacting the other directly. Now, what is done in a vendor audit or a vendor due diligence? You gather all the background information about the vendor, his actual versus committed time of delivery, number of missed deliveries, number of delayed deliveries, number of commitments not honored. If this activity is not done properly, if this activity is not done in as much detail, there is a possibility that you will end up onboarding a vendor who is not really up to the mark and who has a history of bad deliveries, and that will impact your business ultimately. That will lead to a supply chain disruption. Whereas, see, these are related risks. Okay. What are correlated risks? Risks that move together but don't cause each other because they share one common driver. For example, oil price and airline ticket prices might be correlated due to one common item, which is the fuel cost, but one doesn't cause the other. See, why this matters is mitigation for related risks may focus on breaking the causal chain, improving vendor controls. If you want to lower the probability of disruption to your supply chain, you should probably perform a detailed vendor audit. And so you can implement controls, you can break the cost for that particular delay, you can break the cost for that particular non-compliance, right? Whereas when it comes to correlated risks, you will have to find out what is the common factor causing all of them, and you will have to tackle that. In India, monsoon variability is correlated with agricultural yields and rural consumer demand. Both revenues of FMCG firms may fall simultaneously. Here, diversifying into urban centric product lines reduces correlated exposure. See, uh, how the monsoon turns out in a particular year will impact the agricultural yield. If it impacts agricultural yield, then agricultural produce will be impacted because of monsoon variability. If the people in rural areas who are dependent on agriculture, if their production is low, that means their income is low. And if their income is low, then they will not be demanding non-essential goods, or they will probably divert their demand only towards essential items. So the impact it has is you need to find out, is there something that you can do to tackle? I mean, you cannot change what happens with respect to the monsoon. And you know that if it's bad monsoon, then agricultural yield will go down and purchasing power of people in rural areas will also go down. So if your FMCG firm has a huge rural customer base and it also, sells a lot of food grains and, agricultural items, then naturally you will suffer on both counts. So in this case, diversification into urban centric product lines will reduce your correlated exposure. That is the difference between related versus correlated risk. Okay. Now let's understand how what role does the risk manager play in all of this? See, let's understand that the risk manager is at the very heart, is at the very center of all of this. The chief risk officer or head of risk is the linchpin in many cases. See, you he's of course burdened with a lot of responsibilities, and his KPIs are also dependent on that. Now, some of the core responsibilities that a risk manager is burdened with is designing and maintaining the risk framework, maintaining the risk register, scorecards, dashboards, then coordinating cross-functional lines, uh, cross-functional risk and scenario planning, then recommending TARA options and getting the resources approved, ensure compliance and lies with internal and external auditors. And how his KPIs will be defined, is also going to be a tough task. For example, percentage of top risks with assigned doses, what are the mitigation plans, or time to close high priority control gaps in days, or percentage of critical incidents detected via automated monitoring versus manual detection, or board satisfaction score for risk reporting. See, ideally, the CRO, that is the Chief Risk Officer, he reports to the CEO for independence purposes. And of course, he's also connected with the risk with the audit committee. So this preserves operational insight but keeps his assurance independent. You will have to mention how many Indian banks have started having, chief risk officers reporting directly to the board level risk committee. And it is ultimately his ownership, and he will have to take complete understanding of what all risks are there, and his KPIs will also be impacted in that very manner. So the chief risk officer occupies a super critical role in, running the entire show. Then, talking about how risk register plays a very critical role. But before we do that, let's talk about his core risk manager responsibilities. First one is, of course, strategic planning, designing and implementing comprehensive risk management processes, and that align with organizational objectives and establish clear risk appetite parameters. The chief risk officer, along with through his consultation with the, sorry, there's a lot of fireworks in the background. The chief risk officer, along with his discussion with the board of directors, along with his discussion with the audit committee, will understand what is the organization's accepted risk parameter, what is the risk appetite, and then he will have to align that with organizational objectives and then design risk management processes accordingly. Then tailoring risk reporting for different audiences, from board level strategic insights to individual accountability frameworks across the organization, making sure that people throughout the entity are aware of what their responsibilities are and how much risk are they allowed to undertake. I mean, let's take the example of a restaurant. Not so A simple risk for a restaurant could be that the wrong order is delivered to the wrong customer. Okay. Or maybe the risk could take the form that a customer has notified that he is allergic to a particular item. And the person who is accepting or noting down the order, that person does not pay attention to this fact and say, I am very allergic to honey. So, and I mentioned this fact, and he does not note down that fact. So, when this person says he is allergic to honey, and when I say I'm allergic to honey, he does not note that fact. He prepares the dish, he serves it on my table, I consume it, and I start bleeding immediately. That happens with me, by the way. Now, if you don't have a if you don't have a risk management program in place, the first thing that you should ensure is that the noting down of that order has to be very clear. There has to be a double check on asking, oh, is there any allergen that, is there an item with which you have an allergy, something like that. And then focus on individual accountability for any lapses. When we talk about education and training, of course there has to be an SOS response to this situation. How do you develop that response? Maybe having those, epipens or those items which those, anti-allergic medicines which you just punch into the person, and I don't know what it's called, anti-allergens or whatever they are called. So having people on the ground, who can administer that anti-allergic. Also, developing your processes and training your employees in such a way that they capture the right order for the customer. Okay. Then assessment and evaluation, conducting thorough risk assessment and evaluating the effectiveness of previous risk handling approaches to continually improve the process. The person who is actually the chef in a high-end fine dine restaurant, that person, when the order goes to him for preparation, he should double check whether any allergens have been noted or not. Then risk mitigation would primarily involve protective measures including insurance coverage, health and safety protocols, comprehensive business continuity planning. Imagine two or three people get hospitalized and they are in the ICU because of, uh, this food poisoning event due to an allergic item. Now there is going to be reputational damage. How do you tackle that reputational damage? That is also the responsibility of risk manager. And then governance and compliance, conducting policy audits, ensuring compliance with standards, and managing relationships with internal and external stakeholders. How do you make sure that all the stakeholders are kept satisfied to the level that is justified with them without incurring too much cost? Because any stakeholder becoming disgruntled with you might have long term implications, which brings us to a very important part in the discussion, which is the risk register. A risk register is not a spreadsheet. Okay, it's a control center which basically helps you to A, identify the risk, and then B, talk about who is the risk owner, are there any fraud risk factors involved, so on and so forth. Okay, now when we talk about the risk register, let me show you what a risk register looks like. Okay, this is something I had prepared for the pre-scene material in the previous quarter. So risk, single factory outage or customer churn or cybersecurity or data breach, then the cause of that breach, then the consequence, who is the process owner, and what is the response that you have planned in order to mitigate the risk. Are you going to treat it? Are you going to transfer it? Uh, are you going to take an insurance cover? How exactly do you plan to handle this particular risk? So this risk register, it is a, just one moment. We discuss the risk register in the next video. There are far too many firecrackers, and I think that might impact the quality of the audio. So I'll discuss that in the next video.